mind, looking for a dime. James Locke in the house, gonna help you shine.
Hello and welcome to the Poole Locke YouTube channel. I'm James Locke, and today we're going to answer some of the Ask James questions of the day. We have this question from Patty. She says, I'm about 12 years out from retirement, and yes, I am very worried about the upcoming presidential election. I do want to make the transition to the income first approach, but I'm worried that my fear is actually going to affect what I choose when it comes to income strategies. Okay, Patty, if you're really concerned, you're probably going to gravitate towards more conservative options when you make that transition to an income first, growth second approach. You're likely to look at bonds first because bonds are contractual. Let's break this down a bit. Bonds pay a contractual interest payment and really need to default, right? That's when the issuer goes bankrupt before they stop paying, right? So long as you pick good companies or government bonds, that's a more conservative route. Now, a step above that in terms of risk is probably preferred stocks. Now, preferreds are technically a class of stock, Patty. But they pay a fixed dividend. Although companies don't necessarily have to go bankrupt to stop the dividends, they treat preferreds much like bonds, and they typically pay a little higher rate than bonds do. So if you're really concerned, that's where you might want to focus your energies initially. So these options can provide a steady income stream with lower volatility compared to common stock, which can be comforting during uncertain times. If you look at it and say, gee, I don't think my concerns are valid, I think I'm just a bit of a nervous Nelly about this, then you could start to layer on a bit of, let's say, BDCs, business development companies. Now, a business development company is basically a fund that lends money, taking investors' money and lending to medium-sized businesses and companies. So a bond is a loan, and a BDC is investing in a portfolio of loans. The only difference is BDCs are for medium-sized corporations, right? If you're a small corporation, you go to the local bank to borrow money. If you're a big corporation, you issue bonds on Wall Street. So where do medium-sized companies get money when they need to borrow? Well, that's where the BDC comes in. So other options to consider might be real estate investment trusts or REITs. These are stocks of companies that own rental property. If you don't think things are going to get too bad, then that rental income comes through to you in the form of a dividend. Again, a little riskier than a bond or a preferred, but it's an option that can provide both income and potential for growth. And of course, the last one is high dividend common stock, which of course, common stocks can cut dividends, as can REITs and BDCs, but quality companies with a history of maintaining or increasing dividends can be a good source of income and potential growth. Now, depending upon how concerned you truly are, even after watching the show about the markets, that'll guide where in that income first world you place most of your money versus maybe where you just sprinkle a couple of dollars. Remember, Patty, diversification is key. Don't put all your eggs in one basket. A mix of these income-producing investments can help balance risk and reward. Also consider your time horizon. With 12 years to retirement, you still have time to ride out some market fluctuations, which might allow you to take on a bit more risk for potentially higher returns. Lastly, don't let fear paralyze you. It's okay to be cautious, but make sure you're making decisions based on your long-term goals and risk tolerance, not short-term political or market concerns. Consider working with a financial advisor who can help you create a personalized income strategy that aligns with your goals and comfort level. So, Patty, I hope that helps give you a clearer picture of your options and how to approach this transition to income-focused investing. That is a great question, Patty. Thank you so much. As always, if you would like to send in your questions, you can do so by emailing them to poolelock@poolelock.com. Moving on to our second question. This is an email from James. I love getting questions from James. That's my name. So James asks, How do annuities fit in the current political landscape and investing for retirement? So in these kind of political questions, I haven't really touched on annuities or mentioned them at all. Now, I have talked about annuities before and how they work, and I've done some radio shows on them as well. But let's dive into this topic a bit more, as it's certainly relevant for those investing for income in retirement. There are 4 different basic types of annuities, James. The first is what we call an immediate annuity. It's basically like a pension. You put your money into a contract with an insurance company, and it's irrevocable. You can never get that money back because you've exchanged it for a guaranteed lifetime income stream, just like a pension. If you live to be 110, they're going to pay you every single year into retirement. But if you die after 1 year or 2, the insurance company keeps the rest of the money. So these immediate annuities are good for people who are behind the 8 ball in retirement, where they don't want to extend their retirement age. They want maximum income from whatever it is they have. And they're willing to give up access to the money for it. That's where immediate annuities can come in handy. But James, the reality is I find that only a few percent, maybe 3% of annuities out there are by people buying annuities by immediate annuities. So why is that? Because when you start talking about making a decision that's irrevocable, that you can never change, you can never access your principal, you can never increase or decrease your income, people need to think long and hard about that commitment. Second type of annuity is a variable annuity. And that's where you're basically in securities, you're in the financial markets taking risk. Now, most of these are designed for younger people who want to be heavily in the stock market, who are willing to tie their money up until age 59 and a half for tax deferral. So they say, hey, I'm willing to tie my money up to 59 and a half to get that tax deferral and be aggressive in the financial markets. But again, they're for people who want to take more risk. Now, if you're retired or close to retirement, James, and I assume you might be, as you're calling, as you're writing in and questioning here and listening to the YouTube channel, then you're probably more interested in a fixed or fixed indexed annuity. Now, these are really the 2 types that I think are most appropriate for the majority of people that are retired or within 10 to 15 years of retirement. And especially if you're really concerned about risk, and even corporate bonds and preferreds give you a little pucker factor, then that's where these types of annuities come in, because they have even less risk of default than preferreds or bonds. Fixed annuities offer a guaranteed interest rate for a specific period, much like a CD, but often with better rates and tax-deferred growth. So fixed index annuities, on the other hand, offer the potential for higher returns based on the performance of a market index, but with the protection against market downturns. So your principal is protected and you can potentially earn more interest than with a traditional fixed annuity. Now, it's important to note, though, that annuities are complex financial products. They come with fees, surrender charges, and other considerations that you need to understand fully before investing. So they can be a valuable tool for creating guaranteed income in retirement, but they're not right for everyone. Also, keep in mind that annuities are insurance products, so the financial strength of the insurance company is crucial. You want to make sure you're dealing with a highly rated financially stable company. Lastly, annuities should typically be just one part of a diversified retirement income strategy. They can provide a base of guaranteed income, which you can then supplement with other investments like bonds, dividend-paying stocks, or REITs, depending on your risk tolerance and income needs. Hey, James, I really hope that helps give you a clearer picture of where annuities might fit into an income-focused retirement strategy. Remember, it's always a good idea to consult with a financial advisor who can help you determine if annuities are appropriate for your specific situation and how they might fit into your overall retirement plan. Great questions today. Thank you so much. As always, if you would like to send in your questions, you can do so by emailing them to poolelock@poolelock.com. And if you like what you heard, like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.